I'm with Robert on this one, that I think, and I think many colleagues have also re-emphasized that message, that markets are getting ahead of themselves. It's pretty clear. And the problem for us is that in the end that might become self-defeating. I mean, we are optimistic that we have a credible prospect of a return of inflation to 2% in 2025. But a lot still needs to go well for that to happen. Underlying that projection is an interest rate path, an assumed interest rate path, that contains significantly less easing than is currently embedded in market pricing. So, yeah, that runs the risk to become self-defeating. We will stick to our guns. We will stick to what we believe is the right interest rate path to take us to that 2% objective in 2025. We think we can do it, but there are risks out there. There are risks out there with an incredibly tight labor market, which continues to outperform expectations despite the slowdown in the economy. Our labor market continues to add jobs despite the slowdown. Unemployment continues to be at record lows and stabilizes there. And then, of course, we have some uncertainties coming from the geopolitical front, what is happening in the Red Sea, what that might be doing to shipping costs, etc. So we have to continue to be on alert. If we are going to remove some of the restriction that we currently have in place, it will be a very gradual pullback, but not a head over heels pullback. And we definitely will need more data on wages. We will need to see that wages will also have turned the corner, because we're not going to have the disinflation according to our projections if simultaneously we will not also see a turnaround in wages.
Yeah.
You may not get that wages data though, right? I was talking to the CEO of Manpower here yesterday. He was saying, look, the starting point for unemployment was so low and we still have tight labour markets, so we may not see much movement when it comes to the unemployment rate. What is the Nauru these days? When we think about the old days of where it used to sit, where is the Nauru now?
Well, I don't know where it is, but what I do know is
that's
that...
alarming. If you're setting policy and you don't know where it is.
No, but I do know directionally that I think that the current rate of unemployment is below all estimates of the Nauru that I have seen from different corners. But we know these are unobservables, R-star, Nauru, and what have you. They're also not completely stable over time. I do think there is also a conjunctural element to them. So I'm careful in not trying to be overly precise. I think we should be humble in this regard. But it is true that from the policy community, from the academic community, all the estimates of Nauru for the euro area are actually north of the current unemployment rate. And that should be a signal for us to be cautious.
Help me out with some monetary policy gymnastics around a pivot, because no one expected one from the Fed late last year. We got one. Now the market's saying, well, how quickly can we see a pivot?
We haven't had it yet, Karen. We had an indication.
Well, I wouldn't talk about a pivot. I mean, we are on the plateau at this moment. Yeah? And I agree with those who say that it's rather unlikely that we would have to increase rates again. If some of the, let's say, upside risks were to materialize that I just discussed about, I think we would invest more in duration of the current level of interest rates rather than thinking about additional increases to them. But it might imply that the first cut might come later than is currently anticipated.
But Klaas, sorry to jump in, but the first cut's already happened. And it's because the money markets and the bond markets, same in the Federal Reserve, they've taken us down from 5 to 4%, and it's the same on the BTPs, on the OATs, on the bunds, you name it as well. Anyone raising money in the markets has already had their first cut, and that's the market's taken it away from you a little bit as well. So have they, when Powell used to talk about the market doing the work for us by having tighter money, well, is it working in the opposite direction by money being easier for now for many people, countries and individuals?
Well, of course, we look at the overall set of financial conditions, short rates, long rates. The more easing the market has already done for us, the less likely we will cut rates, right? The less likely we will add to it. That's what I mean by self-defeating. I think there are expectations of our policy rate movements in current markets that we will not vindicate. Once it becomes clear to markets that we will not vindicate, I do expect some correction back to the interest rate path that was underlying our optimism of a gradual return to 2% inflation in 2025.
Yeah. Can I ask you about the impact of fiscal policy on monetary policy from here? Because we have seen a ton of spending at government levels and a European level, huge handouts across states. To what extent is that now undermining your ability to move on monetary policy in 2024?
Well, my one-line assessment of that would be that fiscal policy has been pursuing different objectives than price stability so far. At the same time, it has not stopped us from achieving a turnaround in inflation and building, let's say, a set of financing conditions with a credible prospect of a return to price stability. So even though fiscal policy has not really been of much help to us so far, it's also not been an impediment. And fiscal policymakers also have a complex set of issues in front of them. So I clearly wouldn't poo-poo sort of the policy dilemmas that they face. But we have essentially been on our own in terms of engineering the disinflation.
The problem is, of course, one of their other objectives, which you're too polite to mention, is one of their fiscal objectives is giving enough money to society to get re-elected. And the problem is we're seeing most of the world looking to be re-elected, democratic world this year as well, from the US to China to Indonesia to we've just had the Taiwan election and, of course, the European parliamentary elections as well. It doesn't help, does it? I mean, the inconvenient issues of democracy and giveaways financially, that could complicate your job.
That may well be true. I still feel quite privileged that I am living in a democracy.
And so do I.
And I think we all should feel privileged that we are still living in democracies. But democracies have political cycles, and political cycles do not always go synchronous with economic cycles. And that means that we have to deal with these such situations. I've been in the job now for 12 years. I've never had a perfect fiscal policy supporting the objectives of monetary policy. It's a fact of life.
No, well, I almost feel we should take fiscal policy away from the politicians, but that might be a bit too radical. I don't know.
So, Klaas Knot, really interesting ECB governor, great personality. He must be fun when he's on the governing council too.
Well, I'm sure he is.
Yeah, but that's what you should ask my colleagues when they come here.
We'll do that next time.
We will.
Klaas,
Thank you
lovely to see you. Thank you very much indeed.
Always my pleasure.
And it's just nice getting a window of actually, because central bankers, they try to make it all dry and everything, but actually, I'm sure you have a lot of fun in your governing council.
We have our fun, and I think the camaraderie and the cohesion of the governing council, that is absolutely something that I think Ms. Lagarde, with her inclusive approach, has stimulated a lot. And I think the product of that is that, the result of that is that despite the fact that we have had to do quite difficult stuff over the last few years, we did it with a very, very high degree of consensus, if not outright unanimity.
Thank you, Klaas.